Master Chan, thanks so much for joining me today. As I mentioned before, we started really interested in some of the points you make in your paper, especially about the changes that are happening in the insurance markets. But I want to start off a little bit about you and what you're teaching and what you're working on right now.
Yeah, so happy to be here. I'm a professor, and I'm an economics professor in Harvard Business School. Actually, before I went into academia, I actually have a bunch of experience in the insurance sector. I was director of strategy and planning at Liberty Mutual, and then I was head of strategy there. And then I went over to United Health, which is a health insurance company, and I was a vice president and then senior vice president there before I became a professor. So I have a long-standing interest in the insurance sector and thinking about risk, thinking about how new technologies like AI, how do they change markets that has a lot of inherent focus on risk, right? Like the healthcare sector, like the insurance sector.
Yeah, and when you talk about insurance, I mean your experience, is around healthcare. Are you also talking about sort of other sectors of insurance, like property casualty,
Yeah, exactly.
along
Yeah,
along the same lines? Yeah, and the
exactly.
reason I'm sorry, go ahead.
No, exactly. I mean, the insights of the papers that I work on, right? For instance, there's some paper on risk adjustment that focuses more on sort of Medicare type markets, but I've worked
Right.
at Liberty Mutual, so I think a lot about P&C insurance as well. And this new work that I put out on risk design actually, applies broadly to various kind of insurance sectors. I mean, reinsurance or cyber insurance even. So happy to talk about it more.
Yeah, and absolutely. And I know in my coverage and reading other coverage of insurers, when you talk about the definition of an insurer and they're thinking about it, you usually roll back to Warren Buffett and his focus on the float, on capital and taking that float, investing in other areas, but insuring off that capital. So a lot of the arguments in your paper get to the heart of that. So I want to start off with my first question. And when finance professionals think about AI, it thinks about helping insurers, price risk more accurately.
Mhm.
You get on earnings call, and that seems to be the constant refrain. Your paper argues that it's actually sort of less interesting than the bigger story. So what do you mean that AI is moving insurance into sort of a risk classification towards risk design? What do you mean by that?
Yeah. So I want to make a friendly amendment to what you just said. I don't think risk classification is no longer important, but I
Mm.
think that the amount of focus of that we place on risk classification in the operation of an insurance company or organizations that think about managing risk broadly, I mean, that has to change. And it has been changing in a certain sense. Even when I was at Liberty Mutual, we've been thinking about telematics, for example, right? Things like that are already shifting it a little bit from what I call risk classification to risk design. But
Mm.
with the emergence of a lot of AI technology, a huge amount of investment on data and predictive models and so forth, that changed a bit, right? So to take a step back, risk classification takes the loss distribution as given, right? The
Right.
insurer, like a Liberty Mutual, right, or like a United Health, right? What they ask is how likely is this driver to crash, right? Cyber insurance would ask like how likely is this company to be hacked, or you could ask how likely is this patient to be, let's say, hospitalized or something. Better prediction is is about better sorting and more accurate pricing.
Right.
Risk design is about sort of the change of the distribution itself. It changes distribution itself. The insurer does not merely predict, let's say, a cyber attack is likely, right? It identifies the vulnerabilities and try to get it patched. It does not merely predict dangerous driving for a similar reason, right? It gives real-time feedback and so forth. Same thing with hospitalization, right? It connects the patients to medication, monitoring, or care, right, before the hospitalization happens. So the distinction here matters because, if you think about it, like the insurance, the insurance is enormous as a sector, right?
Right.
P&C insurance that we mentioned a little bit earlier wrote about like what $1 trillion or so in direct premiums this past
Mm.
year, and then just personal auto alone, right? It accounts for like 350 billion or something like this, right? So when you're thinking about the distribution, if you could just shift it in a percentage sense, or there's a modest shift in the paying loss to preventing them, could really be the next point of where the value could come from the sector. So that's what I'm thinking about, right? So to give someone like a one-liner, you could think of it. Classification, right, is telling us who, like for houses, like who's carrying the mattress. And the risk design would sort of help us stop them from lighting fires, right? So that's sort of like roughly how I start with thinking about, well, as AI become more important, it's always been, insurance company has not always have been in a hybrid for a long time. Even Liberty Mutual 10 years ago was that. But now I think it's going to be more and more that we have to think about, insurance companies as risk design, as one of the centerpieces, along with classification, and not an afterthought.
So, but you mentioned telematics and other technologies have been around for quite a while, and, and AI seems to be a story that's happened over the past 18 months, right? So is AI just accelerating the dynamic that other technologies have already started? Is it, and I guess my question too is AI or is technology driving this trend, or is it other forces? Is it a chicken or egg thing?
I think that the shift has been happening over time, gradually. When the technology gets as good as it's getting, like the AI technologists and predictive analytics get as good as it is, it becomes not ignorable. It becomes unignorable for the major insurance players, because the very underlying object that you're trying to underwrite is changing, and you have the ability to change it. So I think in the past you could imagine that you could run many insurance companies without really thinking about it. Right? Not every auto insurance company offers like serious telematics. Same thing with health insurance companies, right? They don't all do like all kinds of like health intervention, preventative health tech, and all these things. But now AI make it so scalable and so accessible. You really would have to have a very compelling business case, or you're trying to occupy this sort of interesting market niche for you to ignore that part. So I think that's sort of the thing that's bringing it to prominence, as a concept to think about insurance.
So one of the implications I took away is that insurers are, increasingly competing not by like having the strongest balance sheet, but by having, like, as you discussed, prevention, mitigation, helping customers avoid losses.
Yeah.
So are they, are insurers just becoming, I don't want to maybe a degenerative term, but glorified risk managers? Because when you hear earnings calls, they like to talk about their balance sheet. They like to talk about their capital.
Yeah. I mean, Chris, you probably know this, having worked with this industry for so long. I mean, the prominent players in an insurance company, like a P&C insurance company, is very often one of them is the CIO, or Chief Investment Officer.
Right.
I think increasingly, right? I would not say that capital disappears and then nobody cares about what the CIO thinks, right? What I would say is that an insurance company, an insurance product rather, becomes a bundle of three things, right? Which really is the prediction system, number one. Number two is a prevention, and importantly, a compliance system, which coincidentally we should come back to this because this is an important piece about the intervention, not just the risk management. The third piece is the financial promise to pay whatever risk remains, right? I think a good example is like cyber insurance is a relatively good example, that they're sort of moving in this direction. Some insurers, right, they scan networks, alert firms to expose systems, recommend patches, and so forth. I mean, with all these new AI being so crazy that are being released in terms of elevating cyber insurance risk, I don't know how effective these things are.
Right.
But right, coalition markets, this the economic shift from selling reimbursement to selling sort of, for the lack of a better term, some sort of like a closed loop, right? Observe the risk, intervene, verify the intervention, and insure the residual loss. But insurers will not automatically dominate every part of that loop, right? There's a part that is already dominated, right? Because they have the distinctive role that it will pay the residual claims, and they will connect prevention to premiums, deductibles, coverage, and compliance. Which I think in a sense that's in my paper that I mentioned why insurers play such a huge role in this new movement. But a cybersecurity vendor might have better detection software. Or car manufacturers could have a the car manufacturer like Toyota might have better control of the sensor data, right? So it's not clear to me that the insurance policy may become a risk management service with a very large checkbook attached. But because of the nature of that very large checkbook and because of the intrinsic comparative advantage they have in this system and the residual risk that is going to remain and sort of the covariance structures across this risk that you have to consider, I mean, I don't think that it will be a simplistic switch of, oh, now, we should fire all the chief investment officers. What you really only want now is sort of a different kind of, all the AI guys and so forth.
Yeah, that's a good point. So yeah, and to that point, you argue that in theory it doesn't matter. If I read it correctly, it doesn't matter where the AI comes from, the insurer, the customer, the third party. Everyone can observe the price and observe a reduction in risk. So I guess the question is economically, who benefits from it all? Is it the insurer at the end of the day?
Now, this is where I'm actually starting with this example. So you're referring to my irrelevance theorem, which in economics we have a lot of irrelevance theorems, like Coase theorem, like the Modigliani-Miller theorem.
Okay.
In the idealized situation in which we're not worried about adverse selection, right? In that case, that's where I prove mathematically that insurer, customer, vendor, it doesn't matter who provides the technology. Right? Suppose company buys cybersecurity tool from one vendor, the insurer can verify that it's installed and working, accurately estimates the reduction in claims, and give the company basically full premium credit. Right? Then the customer, insurer, and vendor, as you said earlier, are simply alternative suppliers of the same risk. Right? In this case, the least expensive supplier should win. And if they're not supplying it, someone else should supply it, and then they should just pay that person. Right? So so the benefit can then be divided through the prices in this case, right? The customer receives the lower losses and the premiums, the insurers sort of save the claims, and the vendor earns a payment for the technology, if you arrange that way. Competitions determines how much is captured by each one. So the question of who benefits, it's less straightforward, but the efficient amount of prevention, again, in the scenario where we don't worry about adverse selection, that requires a lot of lack of asymmetric information. Then who owns the algorithm doesn't matter. The complication is verification and pass-through, right? So again, when we talk about who benefits from this, we have to think about the verification and pass-through. Did the firm install the software everywhere? Did it act on its alerts, right? Is the homeowner of Liberty Mutual maintaining the defensible space, and is the patient of United actually taking the medications, and does the premium actually fall enough to reward that effort, right? I mean, I'll use health as an example because I recently talked to the folks at the CMS. I mean, think about generous GLP-1 coverage, like Ozempic, right? Combined with metabolic monitoring and coaching, that's a great prevention. The people who value that package the most, right, may also have the highest expected health cost. Now, CMS, Center Medicaid and Medicare Services, the new Medicare GLP-1 bridge illustrates how real this financing question has become, because beginning in, I think, mid this year, right, eligible beneficiaries can receive certain weight management like Ozempic for $50 monthly copay, but a valuable benefit like that attracts the people who value it, right? And in health insurance, that could be both the point and the problem, because now you're drawing on a different population that would enroll in your plan. So in that scenario, the whole irrelevance theorem is no longer as clean.
And when you talk to, whether it's people in agencies or insurers, how cognizant are they of this change happening? Do they see it the way you see it? So,
Chris, I think you're probably much closer in terms of having more people they would talk to, right? I mean, I interestingly, I think these days I have talked a lot more to people in the frontier AI labs or the people rolling out these technologies. I mean, a lot of my students at Harvard Business School also are starting companies that are essentially acting in this space, right? So that I actually have a more of an exposure than agencies and like Liberty Mutual and so forth. I mean, for a firm like Liberty Mutual, I could tell you that they're very cognizant of that being a very important trend. I mean, you could see the hiring that they do. They now have AI teams that they deploy around the world. I mean, they have a team in Ireland, they have teams here. They are aggressively partnering and buying things. So I think people are aware of the emergence of the technology. Now, the question of whether they are aware that there's this whole selection mechanism that might be happening when you're thinking about the prevention attracting high risk consumers. I think plans typically find these things out quite quickly. And at the core of my paper, right, is that I'm actually trying to highlight the fact that it's easy to extrapolate if you only talk to Frontier AI Labs people, because the extrapolation there is, we're going to get rid of all the risk. And as a result, AI is going to solve everything. And because we're going to adopt AI all the way where the marginal benefit equates to marginal cost, for example. That's what we would define as efficiency. But it turns out that when there is something like selection, like I mentioned Ozempic, right? Maybe it's a great thing for all health plans to make Wegovy and Ozempic and all these drugs available to the patients, because I mean, it's just great for patients who are low risk too, because but it's more attractive to high risk. So they will see through offering these plans, and you could see a lot of health plans not doing this, right? Not trying to roll out these GLP-1 benefits as generously as they would otherwise. That's what it is. If they do not roll out these prevention as generously as they would otherwise, there lies an inefficiency where you could imagine the technology could have gotten you to a point in the world where the residual risks to be insured in these insurance pools will be less. But because of selection pressures, we're not getting there. So I think that already some plans, like health plans, are more salient here. You see, because they tend to play with plan benefits quite rapidly and so forth, and so I think that they are aware somewhat, and I think that generally from talking to like people in P&C insurance and health insurance and so forth, they seem to have or cyber insurance. I mean, I think they have a more nuanced view when it comes to this sort of second order effects of all their selection than the Frontier AI Labs people. Those guys are just like, on the gas pedal, like just we're gonna solve all risk and people are just gonna love it, and that's always an incomplete picture.
I definitely get that sense, especially when there's discussions between, what the Frontier AI model makers are working on and their push to go to the next level. I don't want to be reductive, but I just can't get it out of my head because I have been covering this industry for a number of years, and they do talk about their approach to capital, underwriting expertise. They love to talk about distribution. I mean, that's the businessmen. They like to talk about that stuff. But to your point, AI improves. There's definitely a change in the competitive advantage in terms. So, and this is something I want to ask, and I think you got to it a little bit and it's definitely something that insurers are mentioning more is proprietary data, models, prediction models, intervention. Does that become the primary driver of the change that they're focused on?
Yeah. So, does it? Is the competitive advantage shifting towards all these things, right? Like the data prediction models, in which case you're like basically Google could beat everyone in the insurance industry, right? So I mean, and so I would say that I would emphasize, so sort of it's a yes or maybe and kind of, at least importantly there's an and there, is that it will become more and more important as a competitive advantage, and the insurance companies know. If you just look at the amount of investment and collaborate, Liberty Mutual, like they're not just spending money working with people at MIT for out of charity, right? They know that they need this as a competitive advantage. But I will emphasize, and this is the piece that I think a lot of like Frontier AI Labs are less cognizant of, but P&C insurance companies or insurance companies in general are much more savvy about, is that intervention capabilities is more than it's going to be as important, if not more important, than prediction alone. Prediction will often become commoditized. I mean, think about all these Chinese company Frontier AI LLM models that comes out, and it's just like, yes, Anthropic, charges, like, for example, myself at Harvard, I mean, we use these models and they charge us a ton of money for the compute and everything. Like, I could use the same model from, like, open source from China for free,
Yeah.
And like, oh yeah, maybe I'm like a month behind, Like, prediction will often get commoditized. Many firms will buy similar model, cloud computing, external data, whatever you want. But the durable advantage, I think, comes from closing the loop between the prediction, which is, again, what Google will be doing and so forth, and action, right? The valuable insurer, which, again, you see the savvy insurance executive talking about this, right? Is not simply one that thinks about, like, it's not just someone who would, like, the insurance company would not be someone who just knows that a pipe will burst. It is one that will, like, detect the leak early, contact the customer, dispatch a plumber, right? Verify the repair, update the contract, and learn from the outcome. Right? The same with cybersecurity, driving pattern, and patients at risk of hospitalization and whatever. So I see 4 complementary assets when it comes to what you just labeled as, like, competitive advantage. Proprietary claims and behavior data, for sure. Strong predictions, for sure. But now I underline this next one, which is the operational ability to intervene is the complementary technology that I think insurance companies are very well placed to develop. And then finally, of course, right, there's the balance sheet and license that lets the firm insure what remains. So, I think, so that's sort of how I would think about it. And as a result, right, I don't think that Google is going to disrupt, they're not going to kick, like, Liberty Mutual or Geico off the block. I mean, and I mean, for instance, like, Swiss Re is a good example, right? The current risk data offerings already span underwriting, risk engineering, claims, portfolio management, and not just pricing. So it's a sign that the competitive frontier is moving from who has the best score towards who can turn the score into better outcomes. And they are thinking about this. And so I think understanding that being also part of the competitive edge, and also I remember my last bullet is still a balance sheet and license that could let these firms insure what remains, right? So these things are still going to be very much a part of what you need to be a competitive insurer.
So I guess my question is, like, how do you, for an insurance executive who's listening to this or watching this, like, how do you operationalize intervention? And I'll give you the thing I'm thinking is, because I'm trying to correlate this to things I've worked on. When they talk about wildfire insurance, right, or wildfire risk, they talk about how good the models are, how better they're getting, but that all doesn't matter unless there's mitigation, right? And so I guess the question I'm trying to ask is, where does the insurer make money on intervention, to put it bluntly?
Yeah. So, I mean, this is harder. This is harder to predict, I think, because, I mean, my theory. So the paper that I've written recently on the risk design, right? It mostly think about how we're not going to reach, from a society perspective, the sort of prevention frontier, right? The risk design of the society is not going to be socially necessarily where we want to be in terms of efficiency and optimality. Where they're going to make money from, it would depend a lot on the competition on each part of these different, components that we talked about. I mean, it reaches not just from at the end product, but also increasingly, you mentioned data already, but also talent, right? I mean, if you need to do more and more prediction work, like, can Liberty Mutual or Progressive, and could they beat out, like, companies like Google or, like, Meta and those guys for those AI talent? I mean, I know that a lot of these companies actually, because it's hard to source this talent in the US. I mean, if you go to Silicon Valley, like, you're not going to get the best person. The best person is probably going to work for a tech company in these domains. I mean, so a lot of these companies are actually buying a lot of that talent, let's say in Europe or in Asia, where maybe there's less competition for this. So, I mean, a lot of these things, a lot of these dynamics is much harder to play out. How are they going to make money, where the profits are going to come from? A huge part of it, I think, insurance capital will still be an important part of the formula, right? It'll become less important for losses that can be prevented, like I talk about,
Right.
but not for the losses that remain, especially not for the correlated tail risk. Okay,
Hmm.
AI can predict the losses. It still
Right.
cannot repeal covariance, right? I mean,
Right. Right.
you think of a telematics system. Okay, let's say it reduces crashes and on property mitigation can help houses survive an amber storm. But like hurricane, an earthquake, wildfire, as we've seen in Los Angeles, right? I mean, these could still create like large correlated claims that it's not going to be like predicted away, right? So I don't expect insurers to sort of like, oh, they're going to have to basically make money and the profit's going to come from them looking like insurance company who accidentally also own a balance sheet, right? I
Right.
expect
Right.
the best insurers to be sort of these kind of hybrid institutions. They have the software to reduce the frequency, severities of ordinary losses, and they have the capital and they have the right capital management to sort of absorb the residual and catastrophic risk, right? So capital might even become more valuable, right?
Yeah.
In this world, and as risk design improves, because once preventable noise is reduced, the balance sheet can be concentrated on the genuinely hard to diversify tail, right? So like a very economic sort of funny way of saying this is that I mean AI can reduce the mean, but like someone
Right.
still have
Right.
to hold the tail. So
Right. Right.
I think that's what I'm saying this as sort of a way of reinforcing that I don't really know where the profit's going to come from, but I do know that uh, um, this sort of insurance capital is still going to be part of the formula. Whether it's going to
Right.
be as important as it used to be remains to be seen.
So yeah. To your point, like the tail risk is going to be probably
Yeah,
the most um, less disrupted. So what does that mean? Does that mean reinsurers are safe? Because I know last year Munich Re had talked about this same
yeah.
concept for reinsurers. So what are your thoughts about that?
Yeah, so I will start by caveating that I am not super deep in the reinsurance part of the whole supply chain. So what I say is, more speculative. uh,
Yep.
and so, I mean, my gut intuition is that reinsurers, like I mentioned Swiss Re earlier, so I will keep using them as an example. Like they're unusually well positioned, potentially, to become wholesale suppliers of the risk design infrastructure. And I'll tell you why. They see risk across many primary insurers, industries, and
Right.
countries. I mean, that could give them broader set of data to identify which interventions actually work. Again, I'm double clicking on the intervention point about this, right? They
Right.
can provide catastrophe models, cybersecurity standards, pricing tools, and even like vendor certification for these kind of providers of these risk design, risk prevention element, and capital at the same time, right? So the the primary insurer is still going to have the best customer relationship,
Right.
but
Right.
the reinsurer often might have now the panoramic view that is increasingly important. And so I think that the future reinsurer might need to really at least convince itself that it actually have are able to do two things. One is help primary insurers reduce and resign ordinary risk. Right, if they could leverage a advantage like I mentioned just now, that would be
Hmm.
great for them. And second, they have to think about absorbing the extreme like residual risk that has no monitoring system can remove.
Right.
Teasing those two pieces apart would mean that the business model is going to be a little bit more diverse, but it doesn't mean that it's going to be just one or the other. So I think Swiss Re has begun collaborating on like native AI native reinsurance
Right.
platforms and so forth, and and they are doing more. I mean, not just them, but like and a lot of companies are the risk data products are being integrated into underwriting increasingly, right? So
Right.
I think I think they're still gonna always be like the insurers always need an insurer. Increasingly
Yep.
though, if they play the cards right and they actually see the competitive advantage and get into the right contract so that they get the data advantage and everything that we just sort of hinted at, they may also become the insurer's data scientist. And for that reason, they could even beat out like the frontier AI labs to do these kind of things too.
Yeah, it's interesting. And then to your point, getting into the right contract, I know that's something we're especially
Right.
focused on between the primaries and the reinsurers.
Right.
One thing, and I think you touched on this a little bit in the earlier discussion, most of the discussions around AI assume like AI assumes creates better predictions and leads to better outcomes. But the paper, if I understand it correctly, argues that the opposite can happen. That competition may actually discourage insurers from using AI to reduce losses if it attracts sort of the
Yeah.
wrong customer. I guess adverse selection in a way. Why
Yeah.
is that?
Yeah, so I'm happy that you asked this question because that sort of is one of the points I want to drive home with this paper, right? Because the one line reason for this is because a good prevention package can attract precisely because the customers who need it the most, other people might find the good prevention the most attractive. Imagine an insurer, like I used this example, but I will use health again. Imagine an insurer that this that is designing like a low cost health plan for relatively healthy people. It considers adding very generous like GLP-1 coverage, continuous monitoring, etc., and etc. That package may reduce future hospitalization, but it's especially attractive, right, to people with obesity, diabetes risk, cardiovascular risk, like my uncle and so forth. I mean, people who may have higher current expected cost. If the plan cannot charge for that residual risk, right, and cannot verify enough risk reduction, it is not compensated through the risk adjustment. I mean, if you just take the health insurance case of this, it may weaken the prevention package to avoid attracting those customers. So you can imagine Medicare Advantage plans doing a lot of these things. The same logic appears elsewhere, right? You just think about like cyber security monitoring. Best cyber security monitoring is especially valuable to firms with vulnerable systems, or they know that they're favored targets of cyber hackers and so forth. Right? That creates what I call the risk design trilemma. Is that the insurer can provide the most productive prevention, right? Or maintain separation between risk groups, or avoid cross-subsidizing the people who value prevention the most.
Right.
But sometimes, or most of the time, it cannot do all three. This is not a claim about like competition reducing prevention. It's not that much of a simple point. It is that if prevention is verifiable and premiums fully reflected in lower residual risk, a treated high-risk customer simply becomes a lower residual risk customer. The distortion arises, and this is the important point, where the insurer attracts the baseline risk but cannot fully figure or verify the treatment effect, right? It's like a good lifeboat is especially attractive to people already in the water, right? So selection can punish the insurer that builds the best lifeboat in a sense, and that's what this one is trying to say.
So yeah, and that leads to a question that I've been turning around in my mind is, so does this whole dynamic make actuaries and underwriters more important or less important if they sort of adopt this sort of thinking? What's your, because you can argue it both ways. The actuary and the underwriter can go into and review these AI decisions and apply this sort of thinking, but I'll let you respond to that.
I think great underwriting could become more and more important because I think, like I mentioned, right, the if the and the great underwriting would have to sort of broaden in terms of how they think about sources of risk traditionally, because like instead of thinking about just classification, in a sense there's like this meta level of you also have to then classify whether this how prevention is going to impact the risk itself. So I think underwriters are going to be important. I have a lot of underwriter friends from Liberty Mutual, so I think they're going to be important, but they need to retool. And I mean,
retool in what way? I guess.
Yeah, you didn't quite sort of ask this, but I think like a successful insurer in general, is probably not like a Liberty Mutual with an app glued onto it, nor would it be like a Google with like a policy stapled onto it. The winners will be the firms that closes for loops, and the underwriters will be part of this equation that enables the closing of these for loops. The prediction, like I mentioned earlier, the intervention, the verification, knowing whether the intervention actually occurred, because that ties to this meta meta underwriting point that I was mentioning. And then financing. Again, I keep coming back to this because I think that it's important to remember that we still need to price and insure the residual risk.
Right, right.
And so, I mean, we very often come to the very automated solutions to this thing, and that very well might be true. Like in auto insurance, that might mean like integration of the vehicle with real time safety systems, and then like progressive snapshot like ties premiums to observed drivings and so forth. So okay, like that's sort of trying to automate some part of this premium,
Right.
and thinking about the almost like I'm automating part of the underwriting. Um, Maybe that's the case, but I think that if you think about it in a more macro level, what is primarily classification today um, will need to potentially um, be expanded to think about classification and thinking about prevention. And it might be the same data. Like I mentioned, the
Right.
progressive snapshot data might support intervention also, besides classification. But the strongest firms, would know when not to automate, and they would have the right underwriting, but also like the judgment, the trust, and contracts that sort of assigns responsibility correctly, right? So you're not just underwriting the risk and you're saying, oh, how do you assign the contracts? It's almost like they should think of themselves as a broader contract designer,
Mm-hmm.
and so it's hard to imagine how that would be, and how a lot of our colleagues would need to retool as they
Right.
go into this kind of like insurer of the future. But I think that they should probably start finding out. Otherwise, the world would catch up with them, and they would find out in a less pleasant way. Um,
Yeah. I think they're all thinking that, or I think everybody in a lot of sectors are thinking that. So this is my last question, and I really I could go on all day about this because I
yeah,
have a lot
this
of
is fun
basic
stuff.
questions because it blows my mind, and it's something you mentioned before about sort of like
Uh,
how Silicon Valley approaches this and new entrants approach this issue as opposed to traditional insurance companies. So if you fast forward 10 years,
uh,
what kinds of insurance companies do you think will outperform? Will they look more like traditional insurers? Or are they going to look like technology startups? Is it going to be Google that wins at the end of the day, even though they're not putting capital on the line? Where do you see this in 10 years?
yeah. Hmm. I think, I mean, I think it's a toss up. The two options you mentioned, I think it's a toss up, and I think the outcome is still very much unwritten. Again, this is super speculative. I don't have the data to project this, right? And my theory doesn't actually talk to this point. Now I'm putting on both my hats. I've been a McKinsey consultant before, and so
Right, right, right.
and I've been in health insurance and in the P&C insurance industry. So I'm drawing sort of from a hodgepodge of thing and making like a complete sort of pure speculation. I think really it is a toss up because both sides of the story, right? You start with both two ends, right? You say the traditional insurer, going versus like tech companies. I think it is not. It is somewhat. The if we look at today, it's a toss up.
Right.
If the P&C insurance or the traditional insurers do not make a move right now, or do not expand capabilities, or do not start thinking about risk design as part of what they are doing in the core mission, or as develop it as a core competence of the company, then there will be Google would do well. Now, I still am optimistic about insurance companies just because they have a lot of entrenched advantages to win in this game. Because I mean, to be honest, we talk a bunch about like allocating behavior versus just allocating capital and
Right, right.
changing risk and so forth. But insurance have always influenced behavior, right? Deductible, like create caution. I mean, you have fire code requirements that change like buildings and
Like a
experience ratings.
trusted customer relationship, I guess, in a way.
Exactly. So it's
Yeah.
not like they haven't seen something like this before. It's
Hmm.
just that they would need to like now get ahead of the game and proactively seek out what is the frontier technologies doing, and what would they be capable to do in terms of redesigning the risk, and knowing themselves that we're all bounded by the risk trilemma that I mentioned earlier.
Yeah, yeah.
And so how would optimal offering look like? They could win. The difficulty with tech companies like Frontier Labs to get into this space. I mean, like, let's say Google or Anthropic or one of these places for them to then go into insurance. um, it is a lot harder because, like I mentioned earlier, they have far less experience in the intervention that actually directly impact, the beneficiary behavior.
Mhm.
They have they do not have the relationship with agencies and the
Right.
distribution channels and everything, and so like on the other hand, like the frontier models that are rolled out because of the competition, because of nature, because partly also because China is part of the competition,
Right.
it's really hard for them to hide and make it super proprietary in the way that like the insurance companies cannot take advantage of it, right? I mean, through vendors and whatnot. So
Right. Right.
I think it's a toss up. I think the insurance industry, I love the industry, but I think the biggest enemy is going to be the inertia. I mean,
Yeah.
the industry has it moves slow, and in the past, when technology or predictive technology is also moving slow, fine, you're not going to be as much in peril. But now, think about these models. It's rolling out like every
Yeah.
week. There's a new thing, and so you almost need to have like executives that inject a sense of urgency, and inject more change agents in the organizations, and maybe even really think about the human capital you need in the organization to really catch up with the race. If they do that, I think that my money would still be on traditional insurance companies being able to sustain a good competitive advantage in 10 years. But if they don't, if they are conservative and they are like still doing the traditional thing, I'm gonna just do my underwriting the traditional way. I'm just gonna have a lizard or emu or or flow or one of those, just do advertising for us, and that's how we're gonna attack the market. Then they're probably gonna lose in the 10-20 year time frame. But this is endogenous, so it's hard to predict because it
Right.
involves endogenous behavior.
Great. Those are my questions. Thanks so much for taking the
Right.
time.
Yeah, it
This
is
was,
super fun. I love talking about this, and happy to be here.
yeah, absolutely. Thank you.